The Bears are back, and we're going to start with a report by who is now known as the Cocaine Bear. We're going to start by looking at a perspective from the Cocaine Bear. We'll talk about what's actually happening in the bond market and some massive red flags that are popping up in the bond market, but those red flags could potentially turn bullish. I'll talk about how those red flags could turn bullish. We'll also look at Morgan Stanley's bear case. So if you're looking for FUD, this is probably your video, but that FUD could actually turn bullish, and I'm going to show you how it could turn bullish towards the end of the video. So if you want some fear, uncertainty, and doubt, and see what the bears are saying, but you always want to elevate your perspective, let's get started with the Cocaine Bear from Rabobank. I get quite a lot of direct and indirect feedback to the Global Daily. Some of it positive, some of it negative. However, yesterday for the first time, I was told I was on cocaine for arguing that higher rates can, in some cases, lead to higher inflation. Okay, this is actually a very traditional argument that initially when rates go up, the cost of doing business goes up, and therefore you end up actually in the short term increasing inflation when you start increasing interest rates. This is not wrong, and it's not actually the fundamental point of what I want to show here. However, what I want to show is that this individual reports exactly what I'm seeing in the bond market as well. That Bloomberg, Refinitiv, Reuters, we are seeing all over the place that traders and journalists and analysts are betting that U.S. interest rates may go as high as 6%. Which is the opposite bet that we have been seeing getting made. Now, unfortunately, this is starting to actually materialize in the Fed's terminal rate. We have been sitting at a Fed terminal rate. We've been pretty much range bound. I'm looking at the chart right here between October and the end of January. So January 31, October 1 and January 31. We have been range bound between 5.13% and 4.9% as a terminal rate of where the Federal Reserve is going to end. So basically pretend it's been very, very volatile between that on rate projections. Well, since the jobs report, this terminal rate has actually taken a solid leg up. And that's what it looks like now, is a solid leg up to currently the Fed's terminal rate being priced in is actually 5.33%. Which is higher than what the Federal Reserve projects of a 5.1% terminal rate. Now, that's actually interesting because the Federal Reserve usually likes to massage markets and dialogue before they actually make any kind of rate decisions. Now, this move up was on jobs data. Jerome Powell's already tried to explain down the jobs report by suggesting, well, financial conditions tightened as soon as the report came out, which he's not wrong about. Financial conditions did tighten right afterwards. But it's not stopping people from making bets that rates could go up as high as 6%, and some are even going as far as calling for 8% rates. Now, what's interesting as well is this individual is basically making this argument that we might end up seeing a structural shift in America, that ultimately we build more of our things at home. He calls this the global neo-mercantilism. Basically, hey, you know what? We're going to encourage sending stuff out and selling stuff to other people, and we are going to discourage bringing stuff in because we want to create more at home. It's basically the deglobalization argument. So here, you've got one particular bear who says, look, we could face higher rates, which will actually push inflation higher, combined with deglobalization. Now you're in a situation where you have a recipe for disaster. Rates going up, inflation still going up, leading more inflation pressures because rates keep going up. And what ultimately ends up happening? Well, you end up in a situation of stagflation. This is your classic stagflationary argument, right? Unfortunately, the problem is you're actually seeing now the market try to start pricing in more inflationary concerns. And higher rate concerns. In fact, yesterday's bond auction was terrible, suggesting that markets expect rates to go higher. When rates go higher, bond yields fall, bond prices fall, bond yields go up, right? Rates going up, prices fall. Now, that's interesting because yesterday's auction was so terrible. Why? Well, because basically people think that why would I pay that price for your auctions? I think the price of those bonds is going to go lower, so I'll just wait until it's lower. And sure enough, if you look at the 10-year Treasury yield today, what do we see? We see a 3.69. This morning, we were sitting at a 3.7 handle. We're basically trending back to that 4% level on the 10-year Treasury, which is not only bad for the cost of doing business for companies, but it's also bad from the point of view of real estate. And this is why money is pouring into option bets, betting on higher rates. This is a very clear and consistent belief across the board from Wall Street right now. And one of the reasons is that CPI forecast for next week is not fantastic. The fact that that CPI forecast for Valentine's Day is suggesting we might see CPI month-over-month data reads coming in at 0.5%, which is a 6% annualized rate, is leading a lot of people to say, holy smokes, when that print comes out, the market's going to sell off, especially if we beat it and it comes in higher, right? Worse, the number comes in higher. Then we want to be positioned and hedged. So what are you starting to see? You're seeing a lot more inflows into hedging. You're seeing a very negative outlook in terms of where the stock market belongs to go or should be going. And even this morning, there was a lot of talk from Wall Street analysts about how the only reason we had a rally in January was a short covering temporarily under multiple expansion, which the last thing you want if you're going into a recession is multiple expansion, since usually the first thing that collapses in a recession are stock multiples. Then earnings fall and stocks fall even more. But if you're getting multiple expansion, then you're kind of having this bet that everything's good. You're betting on sort of the fairy tale that inflation's going to come down, jobs will stay strong, which means we won't go into a recession. It's that's obviously the hope. That's the soft landing bet. But people aren't buying it. They're not buying it so much so that previously, as of just 8 days ago, the implied policy rate curve looked like this. On screen now, you will see the implied overnight rate and the number of hikes that you expect to see from the Fed. And what you see is a peak at 4.9%, with cuts starting in July. And then you have this bar that goes really low on the right because those are the number of cuts basically cumulatively incorporated. And you're looking at over 1.5% in cuts by January. That's pretty consistent with the belief that we have over 1.7% in cuts priced in by the end of the year. That chart has completely changed in the last 8 days since the jobs report. The chart does not look anything like what you just saw or heard about, depending on if you're listening to this on Apple or Google Podcasts or Spotify. This particular chart right here shows you what things look like as of last night. You can see 0 cumulative cuts priced in. And this is why we've had a few red days over the last few days here. What do we have? 0 cuts priced in. That's not great. What do we have over here? January 31st, no cuts priced in. And look at that peak. That peak in July, actually potentially suggesting a 25 basis point hike in June and July. That peak now sitting around that 5.3 level. Uh-oh. So, what does this mean? Again, more bearish bets being made on the CPI report coming out. Now, I mentioned to you that there could be a reason that this would end up going bullish, right? Yes, and stand by for that. We're going to talk about that. But first, we got to talk about what Morgan Stanley says, and particularly, I want to look at what Mr. Wilson says. Now, Mr. Wilson is your big bad bear. He's not the cocaine bear, he's just another bear. He is a pretty big bear. And this individual says that, look, while it may take longer for the market to price in materially our below consensus view on earnings and the Fed's restrictive policy, we reiterate that this new bull market is nonsense and that essentially the market is going to go down a lot more. This individual suggests that forward earnings expectations are way higher than they should be. We're finally getting negative revisions. And ultimately, multiple expansion is not why we should be rallying right now. Now, it's worth noting, and I wrote this on the side here, that 60% of S&P companies that reported through January 27th beat, and 69 beat on EPS, and 69%, 60% beat on revenue, 69% beat on EPS. I gotta fix my little note there on the side. But anyway, he suggests that, hey, look, based on their research, forward EPS growth is now negative for just the 5th time since 2000. And history therefore shows that price downside is in front of us, not behind us. And he creates this chart over here, which shows you that we've had negative forward EPS in 2001. And sure enough, prices via the S&P 500 fell afterwards. You had a negative hit in 2008, lower stock prices afterwards. You had a negative hit in 2015. Now this one I'm going to call a little bit of a false flag. This is interesting because yes, even though there was some temporary turmoil in the stock market, that turmoil was really nominal. You're talking about maybe 2 to 3 months of a little bit of pain, but that negative signal right here was a bad time to sell because the market is up way substantially from then. So that was a bad signal. That's where his chart and graph falls apart. Obviously, negative forward EPS in the COVID pandemic, and then now. But if you take out, let's do this for a moment. Let's try to dismantle this. If we take out COVID, if we take out now, because now has not happened yet, and if in 2015 we're like, well, this is bull crap, let's take that out because nothing happened in 2015. Like you would have been better not to have sold then, right? You would have missed out a lot. So if you take out what hasn't happened yet, COVID and 2015, his chart doesn't look that impressive anymore. Now you're only suggesting that, hey, well, stuff was still worse in the in the dot-com bubble, sure, but our stock market today has fallen 3 times as fast as the dot-com bubble. And if you look at the structural problems of 2008, you kind of wonder, like, are we really going to face a 2008? Or if inflation goes away, could we potentially avoid that, right? So, you know, obviously the bears have their arguments and the bulls have their arguments, and that's fine. EPS surprise, he says, in terms of growth, even though it's positive, it's the lowest that we have seen since the great financial crisis. And he does actually suggest, and this is not actually what I'm seeing a lot of, but you are seeing a more long exposure here in January than you have seen since September. Now, this is true, though, because based on surveys, you have a lot of institutions suggesting they want more exposure to like tech and growth, for example, in January than they did in September, but it's still lower than what we've seen throughout 2021. And he kind of cuts this chart off in September of 2021 because, quite frankly, in my opinion, the chart would be a lot higher to the left of that than to the right of this, but whatever. So he's trying to make his case over here. He also then talks about, while some of the upside surprise can be attributed to, okay, this I think is the jobs report. Yes, this is the jobs report. Friday's blowout jobs report. While some of the upside surprise can be attributed to seasonal and longer term adjustments to the data, it's hard to argue the labor data is not strong, which means there's really no reason for equity investors to get excited about cuts in rates. Now, in fairness, the market has already removed rate cut pricing over the last few days. So like if you think the market's still excited about cuts in 2023, wrong. It's already been removed, which on one hand, and this is kind of leading to where my conclusion goes, but my conclusion, don't worry, it still has some more to it. It's actually kind of bullish in some degree because like if the market's already removed price cuts from 2023, and how much has the S&P fallen? Like nominally? I mean, let's look for a moment. Let's go to the SPY. And let's go to the day chart on the SPY. And what do we have on the day chart of the SPY? I mean, look at that. There's like no downside movement over here. So we ran to 418 for a moment at peak within the day. We didn't even close at that. We closed at 415. Right now we're at 405. Okay, well, 405 divided by 415, what are we down? 2.5%? Well, big whoop. Who cares, right? If a 2.5% downside on the S&P 500 is all it took to price in no cuts in 2023, it doesn't sound too bearish to me. Maybe we're all okay with higher rates for longer, you know? But anyway, this individual makes the very strong claim, or in their opinion, that, hey, look, no rate cuts 23, you got more pain coming. That is their argument, right? And if you combine that with the cocaine bear, you have a story that's kind of like, yeah, it's just in the good, right? Now, what you also have is this potential that, yeah, rates could stay higher longer. In fact, Ken Rogroff, who is a Harvard professor, suggests that, look, generally as populations grow and economies mature and democracies mature, generally, looking back over the past 700 years, generally over the history of financial markets, we tend to see a downward trend in the natural rate of interest. However, in that 700-year span, we actually go through substantial periods as long as 15 years where you have deviations from trend. 15-year deviations from trend are a long time. And basically, Ken is making the argument, Professor Ken is making the argument that, hey, keep in mind, it is possible for rates to stay a lot higher for a lot longer than anybody expects. We could be in a higher rate regime for 5 years, potentially. Changes everything. We don't necessarily have to go back to zero in 2024. So, interesting argument. And there's also, of course, the potential that, well, there are really 3 outcomes, and any of these is possible at this point. Look, sure, we can have orderly disinflation, and basically inflation goes down towards 2%. You don't cause substantial damage to jobs and growth, and things are better. Or you have sticky inflation. Inflation falls to like 3 or 4%, but then you get stuck. Then you kind of hope that the Federal Reserve pulls fate out of the bag, which they've been kind of refusing to mention because I think it's a tool on their tool belt that they're not telling the mainstream media and the world about, but I've been yelling about for the past 6 months. Like, it's going to come. They're going to pull that genie out of the bottle. Or you could have a U-shape of inflation where basically these higher yields do exactly what the cocaine bear says, and you end up seeing a second wave of inflation, right? Higher rates with higher inflation. It's all possible. It's all very bearish. Now, personally, I think this bearish positioning that we're seeing getting priced into the market right now, that actually is barely moving the indices, as I mentioned, the S&P 500, not that far down 2.5%, simply by removing rate cuts in 2023, that's a nominal move to the downside for what seems to be a lot of bearish positioning. And this is just my opinion, but I think there's a chance we have a lot of bearishness today and Monday going into the CPI print. And if we get a good CPI print, you could end up seeing another rally to the upside. Now, another large leg to the upside. I don't even think that a big miss on CPI would bring us back to a new low, like October or below. I don't think most individual investors or institutional investors actually think we're going to break a new low. I do think it makes sense to bet or hedge for the potential another leg down, but you do have people like Mike Wilson who are like, oh, no. The real big leg down is still coming. Look at my charts, which obviously I've dismantled one of the charts, one of his primary charts. But hey, you know what? That doesn't mean I'm going to be right. I just want to share the perspective. Again, write these numbers down. CPI month over month projection, 0.5. That's way higher than the negative 0.1 that we had last month. That's a problem. That's headline inflation went up, right? Headline inflation, that's led by energy. It's really led by energy. But you also have core. Ooh, they just revised core. Oh, that's fantastic. The survey for core is now 0.3. That is in line with the 0.3 previously. That is a revision down from yesterday, which actually suggested core would be 0.4 on a month-over-month basis. CPI headline 6.2 estimate and CPI core estimate of 5.4. Interesting. We will see. Obviously, we'll see. But anyway, I want to see what some of y'all are saying here. Are cuts not a bad thing? Usually the economy crashes after the Fed pivots. God damn it. Anybody who watches my videos is like, oh no, here we go again. Dude, fuddle, man. You might be new around here. I appreciate you being a member, but I think I have made like 17 videos talking about how the Fed pivot and the market crashing after the Fed pivot is straight bullshit. I'm going to just simplify and you can just type this into YouTube and get my details on it, but literally yesterday morning I talked about it. The day before in the morning I talked about it, and you can just type into YouTube Meet Kevin Fed Pivot and you'll see me dismantle this. But let me just try to sum it up. In 30 seconds. Yeah, people are, Charlie's like, Foodle has to be trolling. maybe I'm getting trolled here. But let me just try to sum it up in like 15 seconds, okay? The Fed will only pivot down in this recession when inflation is convincingly falling. Inflation is the only reason we are going into a recession. If the Fed pivots, it means inflation is getting conquered, which means the problems are going away, which means we go up, not down. And watch my other videos for why the Fed pivot is just nonsense. Oh, God. Jeez, Lord. Hey, Kevin, how can I send you a gift? 9452 Telephone Road, Ventura, California, 93004. Ay, ay, ay. Fed made it clear that they need to tackle inflation, otherwise people will lose faith. I'd say higher for longer. Exactly, but the higher for longer argument actually reiterates why when the Fed actually does pivot, it's actually a good thing, right? Also, tell us where you got that jacket. This jacket was a gift from my father. It is a Robert Graham jacket. You know, Robert Graham usually puts like a number on each of them. Of how, like, all of the products he makes are numbered. And, yeah, it's a really cool jacket, but they have, like, how many they've made or whatever. I don't know. I mean, this is one of my favorites, because it makes it look like you're wearing a double jacket, but it's clickbait. It's the best. Nobody knows clickbait better than I do. Anyway. What are we going to title this video? Something about prepare for the market crash? I don't know. I think the stuff is a really good video. I mean, I think the content's really good. But some people just read the titles and they don't actually watch the video. And for those people, sucks for you.